Good.
Is it me or is it muted?
I could hear you.
Can we hear Doug? Can you hear Doug?
Hi, Sophie. How are you? Are you there?
Yes, I'm here. Sorry.
Could you make Global Chamber Los Angeles a host?
Sure.
And that'll allow us to move forward. So what I'd like to encourage is maybe when you go through the recording to remove this part of it, and we'll just start fresh. That work for you? So we'll start here again. Sorry about that. We didn't have that set up.
All right, and a quick question. Do we need to do polling questions or anything like that at all for CP, or is this just purely educational?
It's purely educational.
Okay. All right.
So good morning, good afternoon, good evening around the world. My name is Doug Brunke. I'm the founder and CEO of Global Chamber. We have an important conversation because there was recent legislation in the United States that was passed, and there's a large R&D tax credit that is available. It's an opportunity. It's in the new tax law that people should know about. So we've reached out to KBKG, who's actually, normally we've been involved because of transfer pricing, and we work with them as a leading expert on transfer pricing on import-export side. But they also do a variety of different activities on cost reduction. And so we're going to focus in on this tax credit, understanding more how companies can take advantage of it. So thank you so much, Jonathan, for being here today and educating us. As I understand it, there's about 50 minutes time for speaking and Q&A. And we'll just encourage everyone, if you're here and you have a question, to raise your hand and we'll interject during the program. Otherwise, we'll be finishing up around 50 minutes after the hour. So Jonathan, thank you again for speaking. We look forward to learning more. The stage is yours.
Yeah, absolutely. Thank you very much for having me. I'm going to share my screen here just to see if I can get up the slides here. So let me know if you guys can see that. Can you just see the first slide that says big R&D tax credit opportunities?
We can.
All right, perfect. So, as Doug mentioned, we're going to talk about the research and development tax credit and some of the opportunities around this, particularly as it pertains to manufacturing. So I'll kind of start off the presentation to kind of let you know, if I can advance my slide. There we go. A little bit of who I am, a little bit of who KBKG is. And as Doug mentioned, we have worked in the transfer pricing area with your organization before. But we do have some other areas as well. But my name is John Tucker. I'm a partner here at KBKG, and I have over 21 years experience providing these types of services to clients with a specialty in the R&D tax credit. So I've pretty much been doing R&D tax credits for my entire career. And I've worked across all kinds of industries, all types of client sizes. I've been involved in project management. I've been involved in audits and representing before the IRS. I do a lot of training in education as of like today. So I kind of wear many different hats. I am the national leader for R&D for KBKG. We do have offices all over the United States, though. But a little bit about KBKG. We've been around since 1999, and we provide specialty tax services to not only CPA firms that have clients that may impact us, but also direct to market consumers or direct businesses such as yourselves that may be manufacturers or anything along those lines. Some of these specialized services that are beyond, tax compliance. And the little red box on the right-hand side describes the services that we work on. And R&D tax credits is the first one there. That's what we're going to be talking about today. And as you can see, transfer pricing is about halfway down that list as well. We do also work in cost segregation, fixed asset reviews, capitalization. That all has to do with deductions as it relates to buildings and fixed assets and things like that. And we do have some green energy incentive practices as well. That's beyond the scope of this presentation, but obviously there has been some changes in the green energy space with the one big beautiful bill that passed recently. There's still benefits there, but they have been curtailed quite a bit because of that tax bill. As I mentioned, we are located throughout the United States, and we do have offices in Pasadena. That is our headquarters in Southern California, as we were talking about earlier. But we also have offices in Atlanta, Chicago, Dallas, Houston, in New York. So we are strategically placed throughout the United States so that we can be close to any companies or individuals that may need us to come visit them in person. But we do have staff members and partners in each one of these offices. And as I mentioned, I'm in the Atlanta office and I oversee the national R&D tax practice. So today's agenda is we're going to kind of go over the R&D tax credit, what it is, a little bit of its history for some key things that have happened over the course of time. And then also some of the recent changes as it pertains to the tax law and some administrative changes that the IRS has been implementing. Then we'll kind of wrap it up with kind of how you calculate the credit or what kind of information you need to calculate the credit. And then kind of some pitfalls that we see when individuals or companies are trying to calculate this credit. As Doug mentioned, this can be an open forum. So if anyone has a question, feel free to raise your hand or speak up and we can address these questions as we go, or we can wait to the end to see if there's any questions. So it's kind of up to you. So we can be kind of informal here. But let's start with an overview of the R&D tax credit and what it is. So it was first enacted in the early 80s. And really, it was kind of enacted for manufacturers. And specifically automobile manufacturers, but it wasn't defined specifically for that industry. But that was what really spurred it. So if people might recollect, basically in the 70s and 80s is when we started to see a huge influx of inbound automobiles. And so Congress was looking for a way to try to incentivize the big three auto, GM, Ford, and Chrysler, to innovate and to try to compete with the new influx of inbound automobiles. So that was really kind of the crux of it. And so it is that manufacturing was the original start. But as you'll find out when we go through this conversation, it does apply more broadly than just a specific industry. But did want to kind of point that out because manufacturing was really the crux of why they wanted to put this benefit in place. It is a federal benefit. So for every dollar that you qualify for the credit or goes into the credit computation, which we'll go over what those are shortly, for every dollar you spend in the R&D world, you would get about 7 to 10 cents back in a U.S. federal R&D tax credit. So, for example, if you spent $1 million on R&D initiatives, you would expect that you get about $100,000 U.S. federal R&D tax credit. And so that $100,000 would reduce your tax liability dollar for dollar. So it is a credit, not a deduction. So credits are more valuable than deductions because it does reduce that tax liability dollar for dollar. You do have the ability to claim credits in any open tax year. There is a exception for some companies that are in loss situations that might be able to go back and claim credits in closed tax years. But if you did miss credits, any credits or deductions really, in the prior 3 years, that's usually when an open tax year is the prior 3 years, you can go back and amend and claim those missed credits or deductions. So this is something that you go back and get if you haven't gotten it in the past. And as I mentioned, there are some exceptions where people can go back further than 3 years, depending on their facts and circumstances. Also, to the extent you're not able to utilize the credit in the year that you generate it, you would carry it back 1 year first. So if you had tax liability in the prior year, you can use the current year's credit against last year's tax liability and get a refund. Or if there's not any tax liability in that period or not enough, the excess carries forward for up to 20 years. So it's not necessarily a credit that disappears if you can't use it in the year that you generate it. There is quite a big carry forward period. So it is a valuable asset that you can use eventually, even if you're not taxable in the current year that you produce it. Anyone can benefit from it. Doesn't matter your structure, whether you're C Corp, S Corp, partnership, or sole proprietor. Anyone can benefit from this credit, and we'll go over kind of how you understand those different entities can qualify for the credit. And then the kind of little last thing about the benefits are there are many states that offer R&D tax credits too. There are about 36 or 37 different states that offer R&D tax credits. That changes year over year. So just like the US Congress, state legislatures change their laws all the time, tax laws, tax rules. So sometimes credits get repealed, sometimes credits get added back in, sometimes they get expanded, sometimes they get narrowed. So it is kind of important to understand in any given year which states have credits. But like I said, it's usually around 36, 37. They tend to stay in place, but sometimes they do get repealed or a state brings it back temporarily or anything like that. So, what is the definition of an R&D tax credit, right? So this is really the crux of what is generating the benefit. So this second bullet point here, kind of that fission symbol here, is the definition of R&D as defined in the tax code. And so it's an activities-based credit. So it's going to be based on underlying activities that companies perform. And so what you do is you evaluate all these various activities and you determine, do any of them meet this four-part test being the definition of R&D in the tax code. And so the first test is the activity's got to be technological in nature, meaning it's got to rely upon a hard science. So these are your chemistries, biologies, engineering, software development. What we stay away from are soft sciences. So marketing is a soft science. So does a consumer prefer red or blue, or will a consumer buy A or B? That is a soft science. That is not an eligible activity. It's got to be hard science, engineering, software, things like that. The second is the activity must meet what we call a permitted purpose, meaning the activity must be intended to develop or improve a product, process, formula, technique, invention, or software. So these could be brand new revolutionary products or processes that companies have never done before. But more often, where we see companies qualify as in that evolutionary or incremental improvement they make to existing products and processes. So anytime you're trying to make something better, faster, cheaper, stronger, more reliable, more functionality, better quality, that all can meet the permitted purpose test. And then the third and fourth test go hand in hand with each other. What the third test is that at the outset of your activity, there's got to be some form of technical uncertainty. And this technical uncertainty can be in the form of capability, methodology, or appropriate design. So capability meaning you have no idea you can achieve whatever it is you're trying to develop. Clearly a technical uncertainty. But again, where we see most companies qualify is in that methodology or appropriate design. Meaning give enough time and resources, you know you can achieve whatever it is you're trying to do or develop. You just don't know the best way or the most optimal way to do it. So what you do is you undergo the fourth part of the test, which is a process of experimentation to eliminate that technical uncertainty. And that's just an iterative process that you'd go through to evaluate alternatives or test hypotheses. It could be technical discussions, whiteboarding discussions, prototyping, beta testing, trial and error. Just anything that's iterative in nature where you're evaluating different ways or different alternatives, that all can meet the process of experimentation test. So if an activity meets all four of those parts, it's at least initially eligible for the R&D tax credit. And I say initially eligible because, as you probably are all aware, there's always exceptions in the tax rules. So there could be exceptions, but that's beyond the scope of this presentation. But if you generally meet this four-part test, you're generally going to be eligible to claim the R&D tax credit. So once you determine an activity is eligible, right, you're developing a new product that meets all these requirements here, or you're enhancing or adding capability to an existing product. We're trying to make it faster, that type of thing, and it meets this four-part test. Then you go into and you identify the expenditures that go into the R&D tax credit. So remember, I mean, for every dollar that you qualify, you get about 7 cents back in the U.S. federal R&D tax credit. These are the expenditures that qualify. That third bullet point looks like a stack of change. So the first, and usually the biggest driver of R&D credit, not always, but usually are wages that you pay your employees, right? So it's not only the wages of the employees that are directly performing the R&D activity, you can also pick up the wages of the individuals that directly supervise them and directly support them as well. So there's 3 levels or 3 layers of individuals that can qualify for the R&D tax credit activities. So if they're performing any of the research related to that activity, you can pick up their portion of their wage related to that research. So that's the first cost. If you're a partner in a partnership and you're involved in the R&D activities, you're not earning a wage. Basically, you'd be able to pick up in the credit computation is either one, your guaranteed payments for services, those could be picked up as your eligible wage as a partner, or if you have any partnership earnings subjected to self-employment tax, those earnings could be potentially as qualified wages as well. These are for partners that are in the R&D role, helping with the R&D. And if you're a sole proprietor, it's your Schedule C line 31 profit line. So whatever your profit is as a sole proprietor, that could be your individual wage in the R&D sense to the extent you are performing R&D activities. So that's the first cost, wages. Second are supplies that are used and consumed in the R&D process. And these are tangible items that are not of character of depreciation. So they're mostly the consumables that you're using in the R&D process. So if you're going to do a trial run, right? Let's say you're enhancing your manufacturing process to try to speed it up or make 10% more product, well, you got to run some raw material through it to see if you get it to work or if you need to tweak it at all. So those raw materials, those types of costs could potentially qualify. If you're building a prototype, right, or a first of kind, whatever it is you're doing, those costs can potentially qualify. Assets do not count. So if you buy a new piece of machinery that you're putting into your manufacturing process because it's more efficient, the actual cost of the machinery does not count because it's a character of depreciation. So even if you expense that machinery on your tax return, it's still of character of depreciation, so it would not be eligible. But the time spent of the individual setting up that machinery to test the process and get it to work faster, the time can qualify the wages. So supplies, that's the other cost. And the third cost are contract research. And those are third parties that you maybe have engaged to assist you in your research. Those can be 1099 individuals or companies that maybe you've engaged to do research on your behalf or testing on your behalf or anything like that. So third parties can be potentially picked up into your R&D credit computation as well. There is a fourth cost, but it really is only applicable for software developers. So to the extent you're developing any software applications, you're doing it in the cloud and doing your development in the cloud and testing in the cloud, you can potentially pick up some of those cloud computing costs, like Amazon Web Services or Azure or whatever you may be using. That's a cost that can also be picked up, but it's usually not a big cost, and it usually only applies to software developers. And I'm going to end the kind of general overview with industries. As I mentioned, it can apply to any industry, and manufacturing is big and square number one there, because that again was the original purposes of the R&D tax credit. But any industry can qualify. It's just a matter if you're performing qualified activities. So it's going to be based on underlying activities that you perform. So, for example, I'm a partner at a tax consulting firm or professional services. Most people don't generally think professional services as traditional R&D, right? White lab coats, speakers, test tubes, things like that. But we do have software development. We have a lot of tools that we license or sell on our website for people to use to calculate different benefits. Well, that is an eligible activity. It meets 4-part test, so we were able to get the R&D tax credit as a professional services firm. So don't let industry rule it out, but manufacturers are definitely clear qualified activities, or qualified industries. So you look here, this is the general overview of who claims R&D credit. You can see over 60% are still manufacturers. So manufacturing is by far the largest claimer of the R&D tax credit. So just wanted to show that representation there. So let's go over some key areas or key things that have happened with the R&D tax credit. We're not going to go all the way back to 1981. There's obviously been stuff between 81 and 2015 that happened, but that's kind of ancient history. So we want to talk about the big things that happened. So the PATH Act of 2015 did 3 things that were pretty big in the R&D world. One is it made it permanent, meaning it's permanently written into the tax code. So prior to 2015, the R&D tax credit was temporary, meaning it expired, right? It expired every 1, 2, or 3 years, just depending on what Congress wrote into law or how long they extended it or things like that. So that meant that no one could rely on it to be in the tax code. No one could really plan for it. It became a political football, as everyone is probably aware of, when it comes to the tax code. So it was constant negotiation. Do we extend it? Do we not extend it? Well, let's wait 10 months. It's expired. We'll make it back retroactive, et cetera, et cetera. It was really a pain. So the PATH Act made it permanent. So it is permanently in the tax code unless Congress writes it out, which is literally takes an act of Congress to write it out. So it's not a sunsetting provision like it was. And like the many of the things in the One Big Beautiful Bill are sunsetting, R&D tax credit is permanent. Second is it expanded who can use the R&D tax credit. So previously to the PATH Act, you could only use the R&D tax credit to offset income tax, right? And so the whole idea was to incentivize companies to keep jobs here, to innovate, to compete. And a lot of these companies are startup companies, and most startup companies, pay the tax because they're in loss position. So how is that helpful to them? If that's the purpose, is to encourage companies to do this. Well, Congress then put into place the ability for taxpayers to use part of the R&D credit against payroll taxes for certain startup companies. And I'll go over what the definition of that is here shortly. So they expanded beyond income tax for certain startup companies. They can use the R&D credit to offset payroll taxes. And then the third thing is for small businesses, they're allowing them to use the R&D tax credit against AMT tax. So like other general business tax credits, generally if you're an AMT taxpayer, you weren't able to use R&D tax credits against AMT tax. Well, if you're a small business, which small business in this definition is $50 million or less in gross receipts, on average, you can use it against AMT tax. So that's something that the PATH Act of 2015 did. Obviously, you guys might be aware, AMT was eliminated for C Corps. So it's not as applicable anymore, but it does still apply to individuals, so flow through companies. Some individuals can still be subject to AMT, so that's something to keep in mind. So the next thing that happened was the Inflation Reduction Act, although there was something big that happened in 2017 with the Tax Cuts and Jobs Act I'm going to come back to. But the Inflation Reduction Act of 2022 did another thing for the R&D tax credit. So remember I said the PATH Act allowed taxpayers to use against payroll tax. Well, it increased the amount of R&D credit you can use against payroll tax. So the Inflation Reduction Act increased the amount you can use from $250,000 to $500,000 against payroll tax. And not only did it do that, it expanded the payroll taxes you can apply to. So originally, you could only use the R&D tax credit up to $250,000 against the Social Security side of employer Social Security taxes. The Inflation Reduction Act added Medicare as well. So Social Security and Medicare on the employer side of the Social Security or the payroll taxes. So they expanded it with Medicare and they increased the limit to $500,000. So I mentioned who is eligible. I was going to go over that definition to use the R&D tax credit against payroll tax. Well, it's what I call the 5 and 5 and 5 rule. So if you meet this 5-5-5 rule, you would be eligible to use the R&D tax credit against your payroll taxes. And so the first 5 is in the year that you're claiming the R&D tax credit and making this election, you can't have more than $5 million of gross receipts in that year. You can't have had any gross receipts in the 5-year period prior to that year. So my little example here, if you're making this election in 2023, you can't have any gross receipts prior to 2019. That means you kind of been around longer than 5 years, generally speaking, so you're not really starting up anymore. So that's the second 5, right? And then the third 5 is you can't make this election more than 5 times. So that is what a startup company is 5, 5, and 5. And those companies can elect to use the R&D tax credit against their payroll tax. The one difference, call it positive or not, between the income tax version of the R&D tax credit and the payroll version credit is that if you elect to convert this credit to a payroll tax credit, the credit carries forward indefinitely until you use it all. So if you might remember on my first slide, you can carry forward up to 20 years. Hopefully you're able to use all these credits before 20 years, but if you weren't able to and it's payroll credit, it carries forward until you use all of it. So that's the other thing. It doesn't expire if you're using it against payroll. So I mentioned I was going to go back to 2017. So the Tax Cuts and Jobs Act did something pretty significant in an unfavorable way for the R&D world. So everything we just talked about relates to the R&D tax credit. So the R&D tax credit is based on R&D expenditures. Remember the payroll, supplies, contractors, things like that. That's called Section 174 expenses. Those are research and experimental expenditures. The credit is Section 41. So in order for you to claim the credit, one of the requirements is it has to be a Section 174 expenditure. And Section 174 is more expansive than those 3 or 4 costs I just talked about. It includes other things as well. And prior to the Tax Cuts and Jobs Act, it didn't really matter you treated things on your tax return, whether you call it a Section 174 expenditure or you called it an ordinary necessary business expense, the treatment was the same. You got to deduct it in the year you incurred it, right? So you spent $1 million on wages for research, you deducted $1 million of wages for research. The Tax Cuts and Jobs Act changed that rule. And it basically said, okay, for domestic expenditures, you have to capitalize and amortize these expenses over 5 years now versus deducting in the year incurred. And for foreign expenditures, you have to capitalize and amortize over 15 years. So the R&D tax credit is only domestic expenditures, but you can have R&D expenditures that are foreign. So if you outsource any of your, let's say, software development to Germany or to India, those costs are foreign, not eligible for the R&D credit, but are a research expenditure, is required to be capitalized and amortized over 15 years. Domestic was 5 years. So you can imagine this created huge chaos for all companies, but in particular, small companies. So going to my example of $1 million expenditures, you used to be able to deduct $1 million in the year you incurred it, but now you're only able to deduct $100,000 in year one. So there's a $900,000 increase in taxable income in year one when you used to not have that. So this was a very unpopular provision of the Tax Cuts and Jobs Act. And they delayed the implementation of it until 2022. So a lot of people didn't see it until a few years later because they didn't start it until after, even though it was part of the tax law of 2017. So everyone thought that Congress, between the 5 years of 17 to 22, would fix it, but they didn't. So basically, a lot of people got stuck with capitalization requirements, and it became very, very, very punitive to them. So I said we're not going to do any polling questions, so we'll continue on with the latest law change because I wanted to mention that Tax Cuts and Jobs Act because one big beautiful bill that was passed in July this year kind of changed that all again and brought it back to what it was before. So starting in tax years 2025, companies can once again expense their research and development expenditures in the year incurred, and that's 2025 tax years. So there's this gap. There's this 22, 23, 24 tax years that taxpayers were required to capitalize. And again, as I mentioned, this is independent of the R&D tax credit, but they're tangentially related. So that, as you can see, that became very difficult for a lot of people. The deduction's a timing difference. You're always going to get this deduction. It's just a matter if you get it now or you get it over 5 years, right? The R&D tax credit is permanent. You either take it or you don't. So if you don't take it, you don't get it, and it's lost. You know, if the statute expires, it's lost forever. But the one big beautiful bill realized that okay, this was not a good idea. We need to bring this back. So they brought back 100% expensing starting in 2025 for domestic. However, it still retained the foreign capitalization of 15 years. So to the extent you're outsourcing your R&D overseas, you're going to be required to capitalize and amortize those over 15 years still. But there is a kind of a provision. Okay, what do you do with this 22, 23, 24 years where taxpayers were stuck with capitalization? So the one big beautiful bill did put in an ability for small taxpayers or small businesses to basically retroactively apply this expensing provision to those back years as if 174 never happened, right? That they could go back to 22, 23, and 24 and expense those expenditures if they capitalize them. So the one big beautiful bill did put that in for small business. What is a small business? A small business in this sense, for this case, it is anyone that has average gross receipts for the prior 3 years, meaning 22, 23, 24, of less than $31 million. If you meet that requirement, you have the ability to retroactively apply the expensing versus the capitalization for those 22, 23, and 24 years. I have a bullet point here on 280C. We'll kind of talk about that a little later. That has to do with the R&D tax credit and things like that. So I'll come back to that in a minute. But luckily, the rules weren't really clear of what small businesses had to do in the tax code, this one big beautiful bill, in order to avail themselves of this change. Well, luckily, just recently, about 10 days ago, the IRS released Revenue Procedure 2025-28 that provided some guidance in regards to these small taxpayers on how to avail themselves of this change and allow them to go back and deduct these expenses. There is some confusion in there because some of it's pretty written in a weird way. So we do expect more clarity to come out in the next month or two in some of these things that are not clear, but at least there's a lot more guidance on what taxpayers can do. So basically, small taxpayers can go back to that 22, 23, 24 year and claim these deductions if they capitalize them. So one way of doing it is by making the small business election under Section 303 of this revenue procedure, which basically says, I'm a small business taxpayer. I'm electing to deduct these, and I'm going to go back and amend my returns for 22, 23, 24 if I'm amending, or 24 if I'm superseding, or 24 if it's original, to deduct these expenditures. So in doing so, you would just attach a statement to those returns with these bullet points here. You can see the fourth bullet point and the sub bullet points, the name, the taxpayer identification, that you're not a tax shelter, that you meet that gross receipts test, that you're choosing to expensing. You can also choose to amortize if you want, and that you're declaring that you're going to make this change for all years. So this is an all or nothing deal. You can't cherry pick. You either have to deduct all years 22, 23, 24 or not. So you're declaring that you're going to do that. So if you go this route, you are required to amend those years and attach the statement to get that. If you go this route, you cannot file an accounting method change, which I'm going to go over what that is in a minute here, for this particular issue. You're going to be precluded from doing that because you're using this provision to get yourself on it. One thing to note is if you're going to go this route, you have to do this for all years, 22, 23, 24, by July 6th of 2026. So you only have like a 1-year window to make this election for those years. And keep in mind, 2022, I was talking about statutes earlier, usually 3 years. The 2022 statute could expire before that July 6th date. So if your statute expires on March 15th of next year, that is actually your last day you can do it, not July 6th. So keep 2022 in mind if you're going to be availing yourself of this. The second thing you can choose to do in this revenue procedure is you can just, instead of amending those tax returns, you can file an accounting method change for this change. And you can do it on your 24 original return or your 25 original return. So it's kind of up to you which return you do it in. A lot of people want to do it on 24 to get the deductions now, but there's reasons why people may want to wait till next year or not till next year. But you have to file accounting method returns or accounting method changes on original returns only. And so basically what this states is you also would attach a statement to your, let's just say 24 return with this information here. Again, the taxpayer name, tax identification number. This is an automatic change, which means you don't have to get permission from the IRS. If they have a number associated with that, it's 273. You're going to change your method to expensing or amortizing, but let's just say expensing, and on a modified cutoff basis, meaning you're going to go back to 2022, 23 to catch up all those deductions and deduct your 24 expenses in your current year. You also have to declare that you're not a tax shelter and you do that gross receipt test. And so basically you calculate the unamortized amounts of those 22 and 23 years, and you catch all of it in the current year 24 return as a deduction. It's called a Section 41A adjustment. And you could make that method change on your 24 return. If you go the method route, you're precluded from doing what I talked about on the last slide. It's precluded from amending returns, making claims for refunds, and following that procedure. So you have to pick one or the other, or do nothing at all, right? You can do the other thing is do nothing at all. So you could also choose as a small business taxpayer to make this change on your 25 return and catch everything up from 22, 23, 24 on your 25 return. So that is a huge thing. And for all other taxpayers, so let's say you're not a small business, what can you do? You don't have the option as a big business, so over 31 million, to deduct any of those 22, 23, or 24 costs in those years. So big businesses starting in 2025, because again, that's what I mentioned when the one big beautiful bill goes into place, is starting in tax years 2025. Taxpayers can choose to once again deduct their expenditures starting in 25 and they can catch up all their unamortized 22 and 24 deductions on their 25 return 100%, or they can split it over 2 years of 25 and 26. So they're going to have the option. And that again is via a method change as well. It's just a statement, as I've outlined on the other slides, it's a statement with these bullet points here that you have to include. So big businesses have to wait for the 2025 tax year in order to make this method change and also to catch up all their missed deductions or unamortized deductions from 22 to 24. So that is kind of the administrative guidance there. What does that mean for taxpayers? I actually just went through this kind of information. You either can deduct in 25 or equally over 25, 26, or you can just continue to amortize them out. What does that mean? There's big opportunity for taxpayers to catch up missed tax deductions, missed R&D credits. A lot of people forwent the R&D tax credit because they thought it was punitive. It wasn't punitive. It was the capitalization part that was punitive. The credit is a use it or lose it thing, right? So it's permanent benefit. So taxpayers need to go back and capture that if they missed it. And you know, it's bringing things back like 174 from the Tax Cuts and Jobs Act never happened. So everything goes back to normal starting in 2025 for taxpayers. So pretty big opportunities. I'm not going to go through this slide. This is just a example of like a math example of $1 million. Just measures what does it mean for people to go back and claim those deductions and or take tax credits. So I can happy answer any questions related to that. I haven't seen anything pop up in the chat as it pertains to questions, so I'm going to keep going on unless people do have questions. But now we're going to go into some of the administrative changes that have happened as well. So that was all tax law changes, the two code sections, how they kind of interplay with each other. But there was also a change in how you report the R&D tax credits on original returns and amended returns. So the form 6765 is the tax form you use to claim your R&D tax credit. And this is the form you would use on amended returns and original returns. So the IRS released a draft form in 2023 as to what they were going to do with this form and change, and asked for comments because there were some pretty interesting things on the original drafts that were not very great. They did listen to some of the feedback, which is good. And then they finalized the form in 2024. So basically for 2024 tax years forward, taxpayers are required to use this new 6765 versus the old one. So what changed? So really it went from a 2-page form to a 4-page form with an asterisk. And I'll explain the asterisk, why that 4 pages in a minute, because it can be more than 4 pages. So they doubled the size of the form. They added more information to it. So they added 3 sections, E, F, and G, that didn't exist before. Section G is optional for all taxpayers in 2024 and is required for larger taxpayers in 2025, which I'll go over the definition of what a large taxpayer is for this section G. As you can find, the definition of small and large are different for every single provision. But I'll go through who's going to be required to fill out section G starting in 2025. So those were some of the changes. The other thing is they changed the top of page 1, you can see the red box here, of where you make that 280C election, which I alluded to earlier. Or are you a member of a control group? You didn't have to use to answer these questions, but control group basically means, are you under common ownership? They want to know that because technically speaking, if you're under common ownership, you have to evaluate yourself as one taxpayer, even if you file separate tax returns, because they're looking for shifting of revenues and expenses and things in and out of companies. That's kind of why they have the controlled provisions there. But you have to now acknowledge whether you are part of one or not. So that will give them an idea if you have other members that need to be evaluated. 280C is an election that you make in regards to the R&D tax credit. And what this is basically a preventative double dipping provision. Meaning that if you're taking the R&D tax credit, you have what's the calculated credit, which is called the gross credit. And you have the option, if you take the gross credit, where you either one, elect 280C and reduce the gross credit by the highest corporate rate, which is 21%. So if your credit was $100,000, you would elect 280C, you would reduce it to $79,000, and you get a $79,000 credit. That's option 1. Option 2 is you don't elect 280C, and you have to add back to taxable income, or basically reduce your deductions, the credit amount. So in my example, again, if you want to take the $100,000 credit, you have to reduce your deductions by $100,000, thereby increasing your income by $100,000. So you have to pick one or the other. This election is typically only can be made on original returns, and it used to be next to the credit computation, but now it's at the top of the form. So we can see people accidentally missing this election if they want to take it because it's not right next to the calculation. It's at the top. So people need to be aware of that if they're going to make this election or not. But it's the preventative double dipping provision of the R&D tax credit. So that's one thing that changed there, are those two questions. The next thing it did is it added the section E section, which is what we consider the kind of risk assessment session. This is them trying to understand, them being the IRS, is this a potential abuse of a claim, or are they claiming too much, not a little? They're going to use it to judge how aggressive a claim is. At least that's what our opinion is. One is you have to list a number of business components. You used to not have to do that. Business component is the fancy word for the number of things you're qualifying, the number of products, the number of processes improvements, the number of things, items that you're qualifying. You have to list the number out. Two, you have to include any officer wages that are in the R&D credit computation. So they want to know if there's any basically executives in this, right? They're going to view that as a risk assessment, right? There could be reasons why CEOs are involved in R&D, particularly in a 10-person company, right? But if you're the CEO of Coca-Cola, I don't think that would be a wage for Coca-Cola. They're not involved in R&D. So it's going to be kind of a risk assessment. You have to list those out. You have to check the box if you acquired or disposed of any trades or businesses. They want to know, are you being consistent with how you're calculating your credit by bringing in a new company or getting rid of a company? Do you have any new categories expenses that you haven't categorized in the past? Again, are you being consistent? They want to know that. And then are you making the ASC 730 directive election? That's usually only for taxpayers that have audited GAAP financial statements. They can follow their book purposes or book R&D in certain ways. So if you're making that election or not. Section F is just now a summary of the qualified resource expenditures overall that goes to the calculation method. Remember, I said originally you just calculated the credit and everything was at once. Now they've broken down to here's the summary, then the summary goes to the actual calculation method. It's section G. This is the part where I put the asterisk of is it is it 4 pages or more? So section G is now required to list out every single project business component. It's the fancy word that you're qualifying. You can list them all out. As you can see, this page only has 15 lines. Well, if you get 30 business components, you're going to have to attach more pages. So that's why it can be more than 4 pages. But you have to list out the business component. You have to list out what kind of business component it is. The product, is a process, is it software, is it technique? You have to list it out. If it is a software, what kind of software is it? There's 10 different types of software the IRS use. And you have to describe information for each project, each business component that you're qualifying, the information you're seeking to discover there. What is it that you're going to solve? So that has been listed out. Now, versus before, all you did was compute the credit on the tax form. That's it. You just calculated the credit and carried it forward. You didn't have to provide this information on the tax form. You just needed to keep it in your files if you were audited. Now they're requiring it. This page is just an example of the information sought to be covered. This is examples from the IRS's frequently asked question website. What kind of description do I need to put there, right? So this is just some examples from their website. And then the last thing you have to do for each of these business components is you have to provide each category of expenditure for each project, right? You have to provide not only all the wages for it, but you also have to break it down to who is the direct support, who's the direct supervision, and who's doing the direct research. You have to break that out. You have to break out the supplies used for that project. You have to got the computer leasing, that's the time sharing the cloud computing costs, and the contract research. You need to spell it out for each individual project / business component. So who's required to fill out section G? So I mentioned it was optional in 2024 for all taxpayers, but starting in 2025. Businesses that are small businesses do not have to fill this out. So if it's a small business in this sense, one is if you're making the payroll credit election, meaning you meet the 5, 5, and 5 rule, you don't have to fill it out. Or two, if you have $1.5 million or less in qualified spend, so wages, supplies, contractors, if you have less than $1.5 million of those, and you have less than $50 million of gross receipts in the year, you don't have to fill this out. If you fail any one of those tests, let's say you have 2 million of qualified spend and 10 million of gross receipts, you have to fill out G. So you have 1 million of qualified spend and 100 million of gross receipts, you have to fill out G. So it's an and test. You have to meet both requirements in order to not fill out G. Originally, IRS was gonna require you to list out every single project, but that comes quite cumbersome. Think of like Boeing or Merck that might have thousands of projects. How can they possibly list out thousands of projects? Well, they limited it. The max you have to fill out is 50 projects or 50 business components, or 80% of your total for qualified spend. So there is a limit. So, but you could have to fill out up to 80%, or I'm sorry, up to 50 of your projects on that tax form. So that's a lot of additional pages having to be attached. So going on to amended returns. Oh, I see a question here, I think. Thank you. Please share your email. Okay, yeah, I'll share my email here at the end here. So everything I just talked about was the tax form on the original return. So basically, starting in 2021, the IRS said if you're amending a tax return, you have to provide all this information on an amended tax return. That's kind of what started it. And so they're like, we should just change the form to marry it. So that's basically what this chief counsel memorandum did. And basically, they said if you amend a return to make a claim for refund for your R&D credit, you have to provide this additional information. And if you don't provide this information, or we decide, i.e., the IRS decides it's not sufficient enough, you're going to get a letter in the mail saying your claim doesn't meet the requirements. And up until January 10th of 2026, you'll get that letter and you'll have 45 days to perfect that claim, meaning you'll have 45 days to provide that required information to them. Post January 10, 2026, so let's say March 15th of 2026, if you didn't return, it doesn't meet the requirements, they're just going to reject your claim and say it's invalid. Done. It's done. It's rejected. The only way to perfect it is to re-amend the return. And if the statute of limitations has lapsed, then that year is gone. So it's very important that you get this information right from the get-go. Amended return, by the way, that date 26, it's been extended 4 times. So that date might get extended to January 10th, 27. But it's been extended 4 times before, so it might get extended again. Originally, the amended returns was requiring everything we just talked about on the tax form, but also they wanted to know each individual person that's in each business component. So each project can list all the people that worked on it, what each person did on that business component. As you can imagine, that was very, very, very cumbersome. So in 2024, mid 2024, they said, okay, you don't have to provide the individuals anymore or the information each individual self-discover. So they got rid of that requirement. So basically, it's what's on the tax form that I just went through that you have to provide. All right, we're running up on time here, but now we're just going to get into the mechanics. So if you have any questions, please stop me. Or maybe I'll stop for a minute, see if there's questions. Then we'll go over the methods here real quick. It shouldn't take too long to go over the methods.
We have about 3 minutes.
Okay.
And so let's see.
So
I don't see any questions. And so, does anybody have any questions before we
I think I
finish
see
up?
a hand with Francis.
Yeah, Doug, I have one quick one,
Oh,
which
cool.
hopefully it's related to cost segregation. Let's say I've got several scientists, but they're working on several projects, but one are R&D related, others might be related to current support of other things. What requirements are there for time allocations, and how detailed do those time allocations need to be?
Yeah, so that's a good question. So most companies do not track individuals' times to specific projects and tasks. So if you happen to have a time tracking mechanism, that's great. But 99% of companies don't have that. So estimates are allowable. That is allowed. And here it's been litigated. You are allowed to use estimates. So we have a time survey approach that we use where we have discussions on estimating people's time of the year. So a percent of their time. So let's say 25% of their year spent on R&D. So you pick up 20% of their wage in that circumstance. You would want to try to obtain some type of contemporaneous documentation that kind of shows that they were working approximately that. That could be emails, that could be weekly management reports, it could be executive PowerPoint presentations, anything that kind of corroborates that they were working on R&D. That's the type of documentation that you look for. But you can use an estimate, and you can use what we call a time survey approach, where you estimate their activities and projects that they worked on.
Can you get the verification or validation where the scientist employee basically says, I worked at, this amount of time, and he
Yep.
validates it or she validates it?
Yep, you can do that. No, good question.
Sounds good. Thanks for the question. So we have about 2 minutes for to wrap up, but we'll certainly maybe have a little bit more flexibility than that. We definitely need to be done by the top of the hour. How would you like to use the time? What's the best use?
Well, for me, the rest of it is pretty straightforward. I can fly through it if you guys want to see the different methods or the type of stuff you need to calculate, or I can go through example documentation. It's pretty, or if people have questions, we can keep it an open dialogue.
I don't see any additional questions. Does anybody have a question? It sounds like not. So I would say probably just try to wrap up in the next few minutes. I think the goal here is not necessarily to go through every detail of what's involved, but give people in the final couple minutes, a sense of what they should be thinking about, and make sure that they have your contact information. And then I think that should do it. But I think what you've been able to do is lay out some really great information. I presume you're a resource to folks here, and so you'd want people, if they have questions, to give you a shout.
Yeah, absolutely. You feel free to reach out to me anytime in regard to this. I'm happy to walk through it, or if you have questions or validate is an opportunity, not opportunity, happy to do so. I will point out that, this is actually technically called the incremental research and development tax credit. So if you're claiming a credit in the current year, you have to develop what's called the base period. So if you've never claimed it, you got to create that base period. And typically that's the prior 3 years. There's a couple methods, but you're constantly comparing to what you did in the past to what you're doing now. So it's constantly evolving over time. That's why the average, I said, is 7 to 10%, is because it's always evolving over time. So keep that in mind. It's not just looking at it in a vacuum. You have to look at it in the past as well. So this is all saying that IRS, has created, centralized reviews and things like that to try to get their arms around some fraudulent claims or abuse of it. So they've been working around that. But this is the area of controversy to be looking out for. Substantiation. I think, Francis, you were talking about documentation. That's what substantiation is, making sure you have good substantiation. These are some of the other areas. I mentioned executive compensation earlier. They tend to focus on that. Doesn't mean it can't qualify. You just got to be prepared to defend it or have the documentation that proves it. And then what kind of documentation, right? So this last page right here goes through the types of documentation that's usually good in support. There is no specific documentation requirement. It just says adequate books and records. That's it. That's the only guidance you get. But in our experience, this is the type of stuff we look for. You might have some of it, you might have none of it, you might have part of it. So those are the types of things that we look for. So that is kind of the end there. And this is my contact info. So jonathan.tucker@kbkg.com. You can also scan the QR code. You can go to KBKG's website. You can find all our contact info there as well. You can call our direct line and they'll forward you to me, or you can call my direct dial as well. But there's many different ways. So if you get in touch with anybody at KBKG, they'll make sure that you get in touch with the right person, whether it's R&D or transfer pricing or cost segregation. If you reach out to me on those, I'll connect you to the right person. So we'll all be able to connect you to the right person.
Those are the 3 main areas for KBKG.
Yeah, I would say is R&D, cost segregation, transfer pricing, and then it was called Section 199, or I'm sorry, 179D. That's the energy efficient deduction for commercial buildings or architects and engineers that work on a nonprofit or governmental buildings. They potentially get some benefit as well. So if you have any expansion of your manufacturing plants or things like that, you might benefit from a 179D deduction.
Okay. Francis, you asked a question, and I know some of what we're talking about here is in your area. Do you want to just say hi and introduce yourself?
Yeah, Jonathan, great presentation. Very, very detailed. I appreciate it. I'm going to be asking you, I'll email you, if you could send me a copy of your presentation. I'd appreciate it.
Absolutely.
So, yeah, I'll reach out to you. The thing that I'm interested in is I support SMBs, both international and domestic, who are interested in international transactions. So relative to the R&D tax credit, I'll talk to you about some of my client needs.
Okay. Yeah, absolutely. Yeah, feel free to reach out and we can connect on that and I can send you this presentation as well.
Great, thank you.
Beautiful. Thank you all for attending today. Great presentation. Thank you so much for the in-depth information, Jonathan, and all that you shared. Your microphone has a little bit of a defect in it. There were a couple times where it was almost couldn't hear it, and
Oh, I'm sorry.
so when ultimately you hear the recording, you'll hear that there's a little bit of fuzz. I don't know what the technical term is, but there were a couple times it got kind of rough. But for most of it, it was okay, and I think it was all legible. It's just there were a couple times where it almost bordered into, problematic. So probably related just something to your microphone. So.
Oh, thank you for that. Yeah, I didn't realize that. I'm sorry about that.
No worries. I think we heard most of it was clean, but there were just a few times. So thanks again for your time, and we'll talk to you again soon.
Great. Well, thank you. Appreciate it.
Cheers.
All right, go.